Every year, businesses lose an average of 5% of their revenue to fraud. That's not a rounding error. That's billions of dollars vanishing from companies just like the ones you work for or invest in. So how does it happen? And more importantly, how do you stop it? Welcome back. Today we are breaking down one of the most practical chapters in all of financial accounting: fraud, internal controls, and cash. By the end of this video, you will understand exactly how fraud happens inside organizations, what internal controls are and why they matter, how companies protect their cash, what a bank reconciliation is and how it catches errors, and what petty cash funds are and how they work. Whether you are a student, a small business owner, or just someone who wants to understand how money gets protected inside organizations, this one is for you. Let's get into it. Section 1. The Fraud Triangle. Let us start with the big question. Why do people commit fraud in the first place? It is not always who you expect. Studies show that most workplace fraud is committed by long-term trusted employees, not strangers. So what pushes someone over the edge? Researchers identified something called the fraud triangle, and it has three sides. The first side is pressure. This is the personal financial stress someone is under. Maybe they have medical bills piling up, gambling debts, or they are trying to keep up a certain lifestyle. The second side is opportunity. This is where the organization actually matters. If there are weak controls, poor oversight, or no one checking the books, opportunity is wide open. The third side is rationalization. This is how the person justifies it to themselves. They tell themselves things like, "I'll pay it back," or "the company can afford it," or "I deserve this after everything I've done for them." Here is the key insight. You cannot always control the pressure someone feels at home. You cannot always control how they rationalize their behavior. But you absolutely can control opportunity. And that is exactly what internal controls are designed to do, which brings us to our next section. But first, think about this. If opportunity is the one side of the triangle a business can actually eliminate, why do so many companies still leave the door wide open? Section 2. Internal controls. Internal controls are the policies, procedures, and systems a company puts in place to protect its assets, ensure accurate financial reporting, and make sure employees are following the rules. Think of them as the locks, cameras, and alarm systems of the business world. There are 5 principles of internal control that you need to know. First, control activities. These are specific actions like requiring 2 signatures on large checks or locking the cash register. Second, risk assessment. Companies need to regularly ask themselves where they are vulnerable. Third, a control environment. This is the tone set from the top. If leadership behaves ethically, that attitude filters down. Fourth, monitoring. Controls only work if someone is actually watching. Regular audits and surprise checks are part of this. Fifth, information and communication. Employees need to know what the rules are and how to report problems. Some of the most effective individual control activities include separation of duties, meaning the person who handles cash should not also be the person recording it in the books. Establishment of responsibility. Only one person should be responsible for a specific task. Documentation procedures. Every transaction should leave a paper trail. And independent internal verification. Someone outside the normal process should periodically check the work. These might sound like common sense, but you would be shocked how many small businesses skip them entirely because they trust their employees completely. And that is exactly when trouble starts. Speaking of cash, it is the most vulnerable asset of all, so how do businesses actually protect it? Section 3. Cash controls. Cash is unique in accounting because it is the most liquid asset and the easiest to steal. Unlike inventory or equipment, cash does not have a serial number. Once it is gone, it is very hard to trace. Companies protect cash through several specific controls. Over-the-counter receipts are handled by requiring cashiers to give receipts for every transaction, using cash registers that record each sale, and counting the drawer at the end of every shift against what the register recorded. Mail receipts, meaning checks that arrive by mail, should be handled by 2 people together, so no single person can intercept and pocket a check. On the payment side, companies require that all significant payments be made by check or electronic transfer rather than cash, because those create a record. They also require that payments only be made when supported by proper documentation, like an approved invoice. The goal is simple. At every point where money changes hands, there should be a record, a second set of eyes, or both. But even with all of these controls in place, errors and differences still show up. That is where the bank reconciliation comes in. And if you have ever balanced a checkbook, you already understand the basic idea. But there is a lot more to it than most people realize. Section 4. Bank Reconciliation. A bank reconciliation is the process of comparing a company's own cash records to the bank's records to make sure they match, and explaining any differences. And they almost always have differences, even when no fraud is occurring. Here is why differences happen. Outstanding checks are checks the company has written and recorded, but the bank has not processed yet. Deposits in transit are deposits the company has made that the bank has not yet posted. Bank service charges are fees the bank deducted that the company might not have recorded yet. And errors. Yes, both companies and banks make mistakes sometimes. The reconciliation process starts by adjusting the bank balance for deposits in transit and outstanding checks. Then you adjust the company's book balance for bank charges, interest earned, and any errors. When both sides reach the same adjusted balance, you are reconciled. Why does this matter? Because the reconciliation is one of the most powerful fraud detection tools a company has. Unusual entries, checks that never clear, deposits that disappear. These all show up when someone is paying close attention. And the last piece of the cash puzzle is something smaller, but surprisingly tricky to manage: petty cash. Section 5. Petty Cash Fund. Not every business expense can be paid by check. Someone needs stamps, or printer paper, or coffee for a client meeting. That is where petty cash comes in. A petty cash fund is a small amount of cash kept on hand for minor day-to-day expenses. A designated custodian is in charge of it. Every time money is taken out, a receipt or voucher must be left in its place. When the fund runs low, the custodian submits all the receipts to get reimbursed, and the fund is replenished. The total of cash plus receipts should always equal the original fund amount. If it does not, that is a problem worth investigating. It sounds simple, but petty cash is actually one of the most commonly abused areas in a business because people assume no one is watching something so small. And that is the biggest lesson from this entire chapter. Fraud does not just happen at the top with elaborate schemes. It happens in the margins, in the small oversights, in the places where no one thinks to look. Internal controls, bank reconciliations, even petty cash procedures. They all exist to close those gaps. So here is what you learned today. Fraud follows the fraud triangle: pressure, opportunity, and rationalization. Internal controls are the systems companies use to eliminate opportunity. Cash controls protect the most vulnerable asset through documentation and separation of duties. Bank reconciliations catch errors and fraud by comparing two sets of records. And petty cash funds require structure and oversight, even for the smallest transactions. If this video helped you understand how businesses protect their money, hit that like button right now. It genuinely helps this channel reach more students. Subscribe so you do not miss the next chapter breakdown. And drop a comment below with one question you still have about internal controls or cash management. I read every single one, and I might turn your question into the next video. See you in the next one.